Hello everybody, I am Professor Chandana Goswami from Tejpur University, and in this video I will discuss two more activities of a merchant banker, that is portfolio and investment management and corporate restructuring. This video is a sequel to earlier videos that I have posted, that is on merchant banking and issue management. Portfolio and investment management is concerned with efficient management of investment in securities, and this process involves selection of securities to provide investors the maximum yield for a given level of risk. And portfolio management is done with the following objectives. You would like to have return and capital appreciation. So return and capital appreciation means that we are looking out for the regular dividends or the interest that we will receive, and capital appreciation is that there is going to be a positive change in the share price. The second is safety of investment. So when we are talking of safety of investment, we would like to be assured that we will get our annual returns and our principal amount will remain intact. Third is easy marketability. So which means that there has to be a facility whereby it can be traded in the stock exchange, which implies that this security must have liquidity also. So when we are saying liquidity, we mean that it can be converted into cash very easily. And of course, there are tax benefits which we need to keep in mind. There are some investments whose returns are called tax-free returns. All right. So these investments have certain benefits, like you can deduct it from your tax that you have calculated. And minimization of risk is that you don't want a whole lot of variation in the movement in the stock prices. We want it to be within a reasonable limit. So the SEBI rules of portfolio managers defines portfolio manager as any person who, pursuant to a contract or arrangement with a client, advises or directs or undertakes on behalf of the client the management of portfolio of securities or the funds of the client. So which means that there has to be a contract and the client will give the responsibility to the portfolio manager. You can have two types, a discretionary portfolio manager or a non-discretionary portfolio manager. In a discretionary portfolio manager, the manager independently manages the funds in accordance with the needs of the client. So which means in the contract it is specified that what is the client looking out for in terms of the objectives that we had just discussed, and freedom is given to the portfolio manager to manage the fund. But in a non-discretionary one, the portfolio manager will manage the funds in accordance with the directions of the client. So the client is the one who will tell you what is to be done and at what point of time. Should you have more of shares or should you have more of debentures? Should you invest in a particular industry or should you pull out from a particular industry? So in a non-discretionary one, the portfolio manager will have to follow the instructions of the client. It is obligatory to require a certificate to carry on such activity. Portfolio managers are required to enter into an agreement with a client, like I have mentioned that there has to be a contract where you will spell out mutual rights, liabilities, and obligations relating to the management of the portfolio. So what is a portfolio? It is defined as the total holdings of securities belonging to any person. So securities could be shares, could be preference shares, could be debentures, bonds, any of that. And it involves maintaining proper combination of securities so as to avail maximum return with minimum risk. The portfolio management process has the following steps. Number 1, specification of investment objectives and constraints. 2, choice of asset mix. 3, formulation of portfolio strategy. 4, selection of securities. 5, portfolio execution. 6, portfolio revision. 7, performance evaluation. So we will go through these one by one. First one is that we have to spell out our investment objectives. Why is the client allowing you to manage the portfolio? What is the client looking out for? Is it current income? So if it is current income, then the dividends from the shares are going to be more meaningful, and or the interest that you're going to get from your debentures is going to be more meaningful. If it is capital appreciation, it means that we want the value of this instrument to increase over the years. Safety of principle is that at the end of the tenure, I should be able to get my original investment back. Number 2 is asset mix. So in the portfolio, you can have a combination of pure equity, that means only equity shares in your portfolio, or you can invest in equity oriented mutual funds. So you will buy units of those mutual funds which are investing in equity, or you can buy bonds and debentures. So this asset mix depends on the risk tolerance and investment horizon of the investor. Generally, it is believed that young people have a higher risk tolerance and their investment horizon is also long. So therefore, most of their investments go into equity or equity oriented mutual funds. But as you age, the risk tolerance decreases, and so does the investment horizon. So therefore, bonds and debentures become a preferred avenue. Third is formulation of portfolio strategy. You can have an active portfolio strategy or a passive portfolio strategy. In the active portfolio strategy, you strive to earn superior risk-adjusted returns by resorting to market timing, security selection, etc. And in a passive strategy, you hold on to a broadly diversified portfolio and maintain a predetermined level of risk exposure. In other words, in an active portfolio, you are trying to cope up with the market and you are trying to maximize your returns. So you will track market on a daily basis and see how you can maximize returns. In the passive one, you are happy that you're holding on to a portfolio. You don't change it on a daily basis, but you keep track that whether you have been able to attain the targeted return that you had planned. Alright, so as long as you are meeting little more above this targeted return, you are happy with the portfolio. Number 4, selection of securities. So how do you pick up these shares or debentures? You have to do a fundamental and technical analysis of the stocks. So in a fundamental analysis, you are going to do a ratio analysis and judge for yourself about the financial health of the company. That will give you a clue as to whether you should invest in the company or not. A technical analysis does research on the movement of volume and share prices. So it will trace out that over the last couple of years, how has the share price been moving. And normally when you get an investment advice, it is given after doing a fundamental and technical analysis. Then for bonds, you do what is known as a yield to maturity. So this is the anticipated return that you are likely to get if you hold the bond up till the maturity period. Then when you are doing selection of securities, you must have a look at the credit rating. This credit rating indicates the ability of the issuer to repay the principal and interest. Then is tax shelter. There are some tax-free bonds which are available. Normally they are issued by the government and are related to housing and infrastructure sector. And of course liquidity. Is the security listed in the stock exchange? Is it marketable? Number 5 is portfolio execution. So once you have looked at the investment objectives and you have formulated a strategy and you have known how to select a security, you will now buy and sell specified securities in given amounts, because you have this target to be met out there. And this is not the end. You have to revise your portfolio from time to time. You must do a periodic rebalancing, which means that you will shift from stocks to bonds and vice versa. You will also do a sectoral rotation. All this is done with the purpose of maximizing your earnings. And the last one is performance evaluation. You will do an analysis of how much of return did you earn per unit of risk involved, and whether the portfolio return is commensurate with the risk exposure. So this was about portfolio and investment management. We will now move to corporate restructuring. So this corporate restructuring is also another activity of the merchant banker. Corporate restructuring is the radical engineering as a whole or individual work process in order to maximize business effectiveness. There are different types of restructuring that are done: portfolio restructuring, financial restructuring, organizational restructuring. In a portfolio restructuring, there's a change in the asset base, which is done through divestitures, asset sales, spin-offs, like that. What is a divestiture? It is a partial or full disposal of a business unit. So a company may have a unit which is no longer interested in retaining, so therefore it will sell off that unit. This is referred to as divestiture. Asset sale. Let's take the example of a car rental business. Alright, so now I want to upgrade my car rental business. So therefore some of my old vehicles, they are my assets, I am going to dispose them off. So that is asset sale. My company remains, I have only sold off a couple of my assets. Third is a spin-off. A spin-off is that when one unit of the company has grown so much that now it can independently function as a company. Alright, and then it is going to have more value creation in that way. So then you spin off this unit and convert it into a full-fledged company. The Aditya Birla Capital that you see now was once upon a time a part of the entire Aditya Birla group. It was a unit out there. But then it was spun off and it became Aditya Birla Capital. Then second restructuring is the financial restructuring, where you are trying to play with the capital structure. So what do we mean by capital structure? It is the combination of different sources of capital that you use. So your capital structure can have things like equity, debt, long-term borrowing, bonds, debentures, preference shares, retained earnings. Alright, so this combination is referred to as a capital structure. When you want to buy another company, acquire another company, which means that you are going to buy the shares of that company, you can do it with your own money or you can do it with borrowed funds. So when you use borrowed funds for acquisition, that is referred to as a leveraged buyout. Then there is something called a debt equity swap. So this is when the debt holder gets an equity position for cancellation of the debt. So which means that the financial institution which had given you loans, alright, now will convert those loans into equity. So which means the debt is going to be cancelled and now your debt holder will get equity share of your company. So that is a debt equity swap. Then you have organizational restructuring, where you are talking of downsizing and realigning of the business units. A downsizing is normally a reduction of the labor force to create leaner and more efficient business. And a realignment is basically changing the way that a company does business. So the way you do your business can change in terms of that you are trying to embrace new technology, or maybe you have also decided to outsource. Alright, so if you decided to outsource, you don't need regular permanent employees in the organization. This will now help you understand that why companies do restructuring. Restructuring is done to consolidate business operations and strengthen position in a competitive market. Or sometimes there are changes in government policies making mergers attractive. Or maybe the product divisions no longer fit into a company's main line of business. And the last point is that because you want improvement in productivity or you have a cost reduction focus, this requires downsizing of the workforce. So let's look at the role of merchant bankers in capital restructuring. It will examine the capital structure of the client company to determine the extent of capitalization required and prepare a comprehensive memorandum for SEBI securing consent where the capitalization takes place through the issue of bonus shares. Merchant banker will also suggest an alternative capital structure conforming to legal requirements. So it could be that it will talk about the extent of capitalization on the reserves or the quantum of disinvestments through offer for sale, or maybe fresh issue of corporate securities, either one, equity or preference shares. And fourth is the merchant banker will prepare a memorandum covering valuation of shares and justifying the level of premium applied for. Let's look at the role of merchant banker in mergers and acquisitions. Merchant bankers provide advice on acquisition propositions after careful examination of all aspects, like they will have a look at the financial statements, articles of association, provisions of the Companies Act, rules and guidance of trade chambers, issue house associations, etc. They will also undertake management audit to identify areas of corporate strength and weakness in order to help formulate guidelines and directions for future growth. They also conduct exploratory studies on a global basis to locate overseas markets, foreign collaborations, and prospective joint venture associates. They will obtain approvals from shareholders, depositors, creditors, government, and other authorities. They also will monitor the implementation of the merger and amalgamation schemes. They also help identifying organizations with matching characteristics. This point is very important because we have seen that mergers fail because of cultural mismatch. So it is important that there is some kind of matching of the culture between these two organizations that would like to merge. Let me share an example here of what are the things that a merchant banker can do. So this is Chartered Capital and Investment Limited, and they also do restructuring. And can you see what are the things that they do under restructuring? They will do a review of the detailed business plan. They will review various risks associated with the project risk mitigation strategy. They will finalize bankable financial and commercial structure of the project, develop detailed finance plan, negotiate terms and conditions with financial lenders, meet pre-disbursement conditions and financial closure. So this was an example here. So with this, I conclude. Thank you very much for tuning in.